So how much do you really need to buy your first property? Now, people throw out random numbers all the time for down payments. Let me show you the exact costs. If part of you feels behind or unsure where to even begin, that's completely normal. Most beginners have the motivation, they just don't have a clear roadmap. That's exactly why I run a free workshop to give you a simple, beginner-friendly starting path so you finally know what to do next. If you're ready for clarity instead of confusion, the link's in the description. So if we're going to break it down, we're going to look first of all in terms of the down payments. Now, you can get in for as little as 3% conventional, 3.5% FHA, Federal Housing Association. If you're a veteran, you can put down 0%, and if you get certain rural areas with the USDA, you can also put down 0%. But for most of us, 3.5% is typically the lowest. That's the FHA, even if you don't have great credit. If your credit is typically, let's say, 580 plus, you typically can qualify for 3.5% down. Conventional, we're thinking usually 3, but typically 5% down. I've been doing 5% on multiple properties that I've actually been buying. You can put 10% down too. I've done that as well. If your credit is a bit lower, like 500, you can find some lenders that even at 500, you can actually get a 10% FHA down. Now with the conventional, I love those, but it goes all the way up to about 20%. Now this is more in terms of DSCR, debt service coverage ratio. So if you're thinking about a loan where you're not going to live in the property, it's pure rental, then you typically have to put down 20%. Now it can be a little bit lower, it can be 15% in certain fantastic zip codes where the net operating income, kind of like, I won't go into the detail right here, but in terms of the actual net after costs, if what you're earning after costs is pretty strong, pretty solid, then relative to your debt service ratio, you could get away with putting 15% in certain lenders. But it could also go the other way around where it could be up to 30% in the worst possible situations. Still, for most of us, you can live for a year with the intention to live there longer, and then you can always, change your mind after a year and move and convert that property into a rental property. So that's the low down payment, bank hacking essentially. Now there are closing costs, because I know I hear you like, yeah, Michael, that's fine. It seems good, but there are all these things, underwriting fees, like you name it, processing fees, etc. So closing costs, typically 1 to 5% of the actual property. So that can be, small or bigger depending on where you are, where you're going to, what you're doing with the property, what your actual kind of loan looks like, also maybe like the tax area, etc. There's a bunch of other closing costs there, so it can vary quite a bit. Now, inspection is also separate. If you're going in to buy a property and you're not completely risk tolerant, like you actually have some risk aversion, like you're normal, then you're going to want to do a home inspection. It's pretty good. I love doing home inspections. Okay, this is not advice, it's just my opinion, but I don't want to buy a property ever without doing a home inspection. No matter how many properties I buy, I always like doing a home inspection. Now these can cost usually $300-400, but they can go up a lot if you're starting to elect for things like radon, or let's say wood infestation and termites, or other things as well. As you add more things on, your inspection costs go up. Also, if you've got bigger properties, more square footage, or you have something like multiple units, like a duplex or a triplex or a fourplex, etc. Right? The inspection is going to take longer, so the costs go up. There's also an appraisal. So if you're getting a mortgage, well, the mortgage company wants to make sure that, what you're actually getting is a good value. Like you're not actually way overpaying for something. So they might say, look, the property is not worth anywhere close to that amount. So we don't feel comfortable loaning you all this money. So that appraisal comes in, and that's a cost. You're going to have to pay that cost. Now, in my most recent appraisal, I paid $775, but that was a very tricky appraisal. You could probably get it for around about half that if you're looking at a regular single family, like a detached unit or an apartment or a twin home or a row home, etc. Something very normal. My situation, I was buying a fourplex building with a 3-car garage, also detached essentially. So that was a more expensive appraisal. Now insurance as well, you've got to pay insurance, home insurance. You could budget it for $100 if it's like, let's say, just a regular home, maybe even less. But in my case, I was over $200. Okay, so usually it's about $50 per door, but if it's only a one-door property, you're probably talking 75 to 100 per month. So you're going to be paying typically quite a bit in terms of you'll be paying a few months, maybe even a year or even longer in terms of when you're getting into a property, because the mortgage company wants you to pay in advance a few months so that it's there in the escrow account. There's other things as well in escrow. You're paying, for instance, your tax. In my situation, I was paying for the first 14 months of tax. And the area I just bought in, very expensive taxes. I was spending over $1,000 a month, so almost $14,000 in terms of just the escrow for the tax. That was a huge amount to pay out of your pocket. That's not normal. Most areas don't have that high tax and don't have to pay it for that much length of time. So again, it could be those things, but there's also initial repairs. Now, these initial repairs, often it's the case that, well, the seller, you're negotiating with the seller will either solve them themselves before you take possession of the property, or they might actually give you a seller credit. So they'll basically give you money to fix it, remedy it after you've taken possession, after you've been given the keys. So this could be something you do. They pay you to do it. They give you a check based on the quotes, etc. You agree on this, or you might be dealing with a seller that does not want to play ball. It's all part of the negotiation, and if they don't want to play ball and you got to fix it, well, usually these are things you see in the inspection report. I have never so far got a property where I haven't had to fix something. In fact, the laundry list is quite long, but they're all small things. It's almost like, oh, just, clip your toenails and clip your fingernails and, take that dirt out of your eye. Like this, it's all small things usually, unless you're getting a nightmare property, and beginners, you want to stay away from nightmare properties. That's what the home inspection is so good. They'll give you a laundry list of small things. Oh, the TPR valve got to be, 6 inches off the ground, shouldn't be up towards your face, because if the hot water heater suddenly shoots out, if you're turning it off, you don't want it scalding your face. It's better on the foot. Okay, change that. Oh, put an anti-siphon on the exterior, let's say the water hose, the bib hose, things so it doesn't freeze, and so the water doesn't go into the house, doesn't freeze inside. Things like that, you can do it much cheaper in different ways. Not very expensive things, but you can get a laundry list of things. So you may want a few $1,000s or a few $100s at least of things that you just have to fix. It could be that the water heater is at the end of its life, got to get replaced. There could be small little things like, one of the door jambs needs to get fixed, not replaced, instead repaired. Some lock is jamming or something like that. Shave some part of the door. Get a maintenance handy person to come out. Right? You can do that really cheaply. So you may have a few hundred or a few thousand in terms of repairs. There's emergency things that have to be done almost immediately. Then there's kind of like the yellow lights that it would be good to do them within your first year. And then there are kind of green lights that are like, well, this would be good to do, but you could leave it. It's not immediately affecting other things, so you can, take your time when you're going to do it. Now, there's also reserves. Reserves, you want to think about having, if you're risk tolerant, you want to think about having maybe only a few months, like 2 or 3 months. But for most of us that are risk averse, 6 months is a good amount of reserves to have. 6 months of what? 6 months usually of operating expenses. Now, you could just have the PITI, the principal, the interest, the tax, and the insurance, plus any homeowners association fees or any private mortgage insurance, PMI if you've got a low down for conventional, or MIP if you've taken FHA. So this is usually what you call your mortgage, right? What you're paying monthly. They'll take all of these things out per month in your mortgage. So usually if you multiply your overall mortgage by about 6, that's what we're talking about here, 6 months of reserves. Now you could also add a little bit extra for operating expenses. Now you might basically look at it a little bit differently depending on how many doors and if it's an LLC, if you're more professional, etc. You could really scale it. So for me, with one of my properties, my mortgage is about $2,400. So a good sort of 6 months is around about 15,000 roughly, to have 15,000. Now you could basically have this in your Roth IRA, for instance, or high yield savings. It could be wherever, as long as you have money to save it. Eventually you may want to put it into a separate account if you're getting really professional as you build more doors. But look, if this is what stops you getting into your first property, don't let it be what stops you getting your first property. This is my opinion, by the way, not advice. This is my opinion. It's worked for me, so hopefully it'll work for you. But again, it's not advice, just my opinion. Who might know, I'm just a guy on YouTube, been doing this now for a few years, but I've been doing it pretty successfully. So my second property, I basically was paying around about $3,000, $3,300. So having around about $18,000 to a little bit more than that is good reserves for that property. Now my current one is going to be closer to about 6,800 to be specific a month. So that's a huge mortgage, and it's a huge building. There's a lot of stuff involved. So around about 42,000 is probably a good sense of reserves. Now, you might not want to go all the way up to that level. That's almost $1 million property. So you might say, well, just having a little bit extra, like maybe like 300 to 500 per door, if you're having something like a quadplex or a triplex or a duplex. So you do that, and then you multiply that by 6. That's a good idea. Now start small, like 2-3 months, and build up, or you might already have that in your retirement accounts. Now, of course, they're not always the best to kind of consider retirement accounts because you're going to pay penalties and fees and everything like that. But even a Roth IRA where you have the principal you could take out, though it's not necessarily the first thing you want to do. So if you've been thinking about buying your first property, but you feel unsure or behind, listen, you're not behind. You just haven't been given a simple roadmap to follow. Most beginners have the ability to start, they just don't know how. I'll walk you through the beginner roadmap in a free workshop. Tap the link and join us. Again, I like to accumulate, I like to grow at this point in my life, but when you're in the wealth preservation, it might be better to grow your reserves. Now, as I grow more properties, I'm more concerned about reserves, things like this. So again, I'm kind of moving towards being a little more risk averse and hedging, but I am quite risk tolerant. So I'm not always too concerned that I'm building out huge reserves for these properties. I'd rather have more properties than be slowing myself down a lot by having gigantic reserves. Because a lot of the time insurance will cover it, or rent or income or some other way. There'll be some way I'll figure out how to do it. I can put it on a credit card for a month, pay it back the next month when the income comes in, etc. So it's different if you're having long-term income and you're really just your cash flow is zero or negative. But for me, for some of my earliest properties, they're short-term. My middle properties, they're kind of medium-term properties, long-term, medium-term. And the cash flow is still really, really healthy. So I know that, okay, well, I have like quite positive recurring cash flow, and I do put it away. And at this point, I do have reserves. I had reserves to begin with, but I wouldn't be kind of saying that reserves are the major thing to stop me. So again, this is not advice. These are just simple ranges. This is not, this is just to take it as opinion, not advice whatsoever, but to bring it into kind of specifics for my own deals, just for some credibility. So let's look at some numbers right now. Okay, so my most recent deal I'm doing right now, as I'm recording this, I'm kind of going into the final week. So it's now a Sunday night, and it'll be Friday. So another 5 days now, actually. 5 days from now, actually, the keys. Really excited. So it's a $925,000 property. I'm borrowing 95%. That's about $878,500. So I'm putting down 5%, which is about $46,250. Now, to do that with a conventional 5% down, I do have to pay private mortgage insurance, PMI, about $278 a month. But look, I'll pay $278 per month rather than coming up with an extra more than $100,000. Just to basically avoid paying $200 and something, right? That's it. To me, it makes sense because I know in a few years it'll be wiped off. But I also have a strategy to increase the actual value of the property, to reappraise it and then to remove it. So once the value of the property is high enough. Now, there's other things I'm looking at in terms of the down payments and closing costs and things like that. So for me, it was around 18 to 19,000. That's, it's usually like around about 1 to 5%. 18 to 19,000 in terms of title insurance, so that the lender and I are protected, that it actually owner is the owner, the previous owner was the owner, etc. That like there's no one else owning, doing all the background checks for us. There's also like transfer taxes, things like that, the government, etc. wants. And there's a bunch of small fees in terms of processing and appraisals and small little things that had to be done in the closing. There's a bunch of origination fees and profits for the lender and profits elsewhere there that I'm getting paying. But they're all small little bits. Now, that 19,000, there's extra as well that I'm paying. It's not just that in my case. I'm also buying down the interest. I want to reduce the interest rate on my loan by almost 1%, from almost 7% to just over 6%. Now, you don't have to do this. There's some cases where it's good, there's some cases where it's bad, but for me, I am paying that extra 17. So my closing costs were 36,000. But it would only be 18, 19,000 if I wasn't doing this more advanced strategy. But in addition to that money, that closing cost, again, 18, 19,000 plus the extra, so it brings to 36, so bringing it down the actual interest rate. But I'm also paying about 19,000 in terms of prepaid. So paying the first few months of things like the taxes, the insurance, even the interest rate that I'm actually paying for the first 2-3 weeks, and things like that, even extra insurance. So I'm paying a little more in terms of prepaids. But those are things then that I get to enjoy because I've kind of paid them down, so I get a break before having to pay them again. So that's nice, that extra 19,000. You can kind of look at it as like, it's not fully a sunk cost. It's going to basically allow me live there for the next few months. So my down payment of about 46,000 plus the closing costs of 36,000. Inside that, there is the 17,000 I'm paying to reduce the interest rate. You don't have to pay that if you don't want to. There's also the total prepaids or reserves, about 19,000. So the total funds that I need to close this are about $102,000. So 46,000 down payment comes to 102,000 when all is said and done. But don't forget, almost 20,000, 19,000 to be specific, 19,000 of that 100,000. That 19,000 is a prepaid. So I'm paying for what I'll be living in there for the next year or so, in terms of taxes anyway, and a bit of insurance. So that's good. And also from that 100,000, in addition to the 20, bring it down to 80, 85, let's say, there's also the fact that I've got 17,000 of reducing the interest rate. So it could be 80, 85,000, but then realistically, you know, it's about 65,000, the real cost. So again, 80, 85,000 just to get into the property, right? If I didn't want to lower the interest rate, so 46 down and it came up to about 80, 85 just to get in. But then because I wanted to lower the interest rate, it brought it to about 100, 102,000. Now that's pretty good. Now the thing is that could have got it down to about 65 if you really think about like the true cost to acquire, about 65,000. Because going from 65 to 85 is really you paying the first year in terms of tax, insurance, etc. So you are getting to live there, essentially discounted for the first year to a certain extent. And by the way, my insurance was around about $200 a month. That's home insurance. That's for 4 units. So that's amazing, right? Plus a garage. So there's that. And of course, beyond that, that's the escrow. It's all in escrow. Beyond that, of course, there's the appraisal. That was for my property. It was $775. That was for the mortgage company to figure out how much this was worth. There was a third party that they would hire to do this appraisal, and that just made sure that they weren't giving me, you know, this massive loan of almost $900,000 to buy this 925 property. But if they discovered, well, look, you know, the home is only worth $600,000, we can't give you a loan for almost $900,000 because if you don't pay us when we then take over your property, we're going to basically lose a lot of money. So they want to make sure that, you know, what I'm buying is commensurate with their loan. So that fee that I had to basically pay for them to get someone to do the appraisal was about $775. But it would be cheaper typically if you were looking at a more standard, that's my understanding anyway, cheaper for a more standard property like a single family. This was a fourplex, very rare, only about 300 that I could find, 300 of these in the 4-county area, which is a gigantic land district. So even in my town, very, very few. Like they're like unicorns, very, very rare where I am. So trying to do that, normally in appraisal, they want to like look for a similar property that was on sale that sold rather in the last 6 months that's within half a mile, just so they're similar tract, etc. But in my case, they probably were looking within 2 miles or larger, and it was probably over 2 years, right? So it was really good. They did great work, but it was difficult for them. So that's why it was a bit more expensive. If this video is helping you understand this part of your financial journey, you'll get even more value from a free workshop I host for beginners. In this workshop, I walk you through a simple roadmap that shows how you can buy your first property with realistic savings and a lot less confusion. If you want to take everything you're learning on this channel and fit it into one clear plan, the link is in the description. It's completely free. Now, finally, the inspection. So there are just regular home inspection. You don't have to do it, but I think it's a good thing. And that's my opinion. And in my case, the home inspection is a bit more expensive. Normally, you can get a home inspection for about $300 to $400. For me, the base was $395, but because there was 4 units, there was an extra fee of $225. And above that, because the property was large, now actually they charged me for about a 2,000 to 2,500 square foot building. My building was actually way over 3,000 square foot. Could have been 6, but wasn't counting. So they actually gonna let me off a little bit, but still I had to pay a little more. That was an extra $100. And then I paid $110 for a radon inspection. That's a separate inspection. And I paid $95 for a termite or wood infestation, or WDI, wood destroying insect. But I also did a sewer scope to look at the lateral, and that was an additional $175. So, I had to pay $1,100 in total, but that's typically not what you pay. $720 for the general inspection, and then the extras, the radon, the wood, and the wood termite, and also the sewer scope. So it ended up costing $1,100. And beyond that, I did a boundary survey. Boundary surveys, they're in around about 1,000. You can get them for less than 1,000, depending on where you are, what you're looking for. In my case, I paid about $1,242 for my boundary survey to see where the edge of my property was. And then I paid an extra $400, bringing the total to $1,642 or thereabouts for my overall boundary survey. The $400 extra being the map. I wanted a map, not just stakes in the ground with pins and ribbons showing me the edges. I also wanted a map for posterity, if you will. So these are extras. They're not required, but I want to give you guys some extra info that it's real. This is live right now in the last 2-3 weeks, because I've only had a very fast turnover here. This is a very, very fast closing period. It's only a 4-week window. We pretty much were in, very, very, I think it was a Friday, 4 weeks. We basically executed on a Friday. We're settling on a Friday, literally just 4 Fridays. So this is rapid, especially for something of this size. And if you want help figuring out your exact numbers, join the free training. Again, you don't have to do this all at once, guys. You can do it one property at a time. So let's build your wealth one property at a time, and I'll see you in the next one.